Hello, everyone. Welcome. We have an extremely special guest, Aaron Levie, the CEO and co-founder of Box. Um, really excited for you to be here. Thank you for coming on, and I'm sure that you're as excited to be here as we are as you. Um,
Totally. Let's talk about some
yeah. So I wanted to. That's great. I actually wanted to bring up maybe a memory or maybe a memory you don't remember. Um, is when I was in the days of starting Shyp that we had dinner. I think it was in Palo Alto. And you took me out to dinner, and I just wanted to kind of like, well, obviously, thank you for that. Like at that time, like
Sure.
Box was still like killing it, and like just like show other founders, like our listener base is first time founders mostly, and like the second time founders and third time founders and everybody is really like other founders that have given me time. Drew Houston from Dropbox, Brian Chesky, probably spent like, I don't know, like 8 or 9 meetings with him when I was like a nobody coming up. And so that's just a really interesting thing that I don't think it happens as much. But kind of just thank you for that. Um, and
Now
hope
you have to use their intro link to book other founders, and you have to pay for it.
right.
Used to be you could get that kind of advice for free.
We figured out how to monetize our time better. So that's just this is just late
Yes.
stage capitalism in the mentorship land.
Why shouldn't I get $500 for walking my dog?
So I wanted to start off with just like one question, and then it's really like a free for all. Uh so my dream is to eventually become a public company CEO. What would you recommend? or
That's literally
or
your
get
dream.
yes.
Kevin is
I am
insane.
I am
Change
like
your
you.
dreams. Change your
I am
dreams.
like you. Like that's
Yeah,
my professional dream.
I see.
Can you give me some advice?
Um, I mean, I would definitely modify your dreams. It is not anything that it's cracked up to be, but uh, I mean, I would say the biggest, I mean, change of being public versus private is just your shareholder base changes, and there's a sort of a scoreboard much more frequently updated, but other than that, I mean, it's all the same grind that we all deal with on the company building front, with just, an order of magnitude more, transparency and sort of externally driven pressure on your results every single day, you're kind of on the clock. But I mean, I certainly, enjoy it, and I wouldn't want it any other way, but it's definitely a grind.
If you could think back to like when you've now been at Box 15 years,
18,
think
yeah.
18 years.
Yeah.
Time
Okay,
flies.
so
Exactly.
all right. If you can like think back to like a lot of those learnings, especially for the first time founders that we have listening here, like what are some of those, maybe some like interesting like anecdotes, or just like times in the company it didn't go right and you were just like, holy shit, like the company's going to go out of business, or just like kind of just sharing like maybe some war stories as you were kind of coming up with Box.
Yeah, I mean, I think, you're always sort of, feeling this sort of existential dread at all times I mean, frankly, to this day, but fortunately, it's uh, the pain and stress level of it is a little bit different. But when you're in the early stages, I mean, every single decision could be the make or break decision of the entire company. I mean, a business model shift, a key employee leaving, a funding round that doesn't close, and so in those early stages, we had, one of everything, that could have gone wrong, kind of went wrong. And I think, the biggest things that I look back on, so, our probably our biggest, our most fundamental decision was our early pivot to focusing on the enterprise market when we had started, not necessarily as a consumer company, but we started sort of agnostic to who the customer was. It could be a consumer, it could be a student, it could be a business.
Mm-hmm.
And I had been pretty determined to keep that be the case, to keep that as the case. And actually my founding team and some early employees and early investors actually were pretty convinced that we should pivot to the enterprise. So I was one of the slower ones to kind of picking up on why that was going to be so important. And we had done some business model pivots and tried different approaches of how we could monetize the product. But eventually, kind of we all came to our senses, and me in particular, where what we sort of discovered was over time in the consumer part of the market, consumer storage would be heavily commoditized because as the price of storage dropped, then big incumbent technology providers should want to give it away for free, because it keeps you in their ecosystem, in their orbit. Whereas in the enterprise market, there's a lot more value that we could build up over time in advanced security and workflow technology, and really, sort of there's lots more range of motion to where we could pivot and build more value. So we decided to pivot the company, and then ultimately, that was a pretty key decision, because effectively everything kind of that we had anticipated did play out in the consumer part of the market. But it was a tough call, and it was certainly a make or break decision. It was very much one of those burn the boats, no looking back once we made that call. But it was obviously sort of fundamental to our survival. And so, lots of those, probably a couple dozen of those in the first couple of years of building the business. And so I think having a founding team that you're super passionate to be able to work with, going after a problem that you're really excited to go and pursue, because you're going to have to get through just an incredible amount of difficult, periods. And then obviously having a lot of conviction on whatever your vision is, are some, pretty fundamental things that I think every founder needs to be able to have.
How do you, I mean, you have a co-founder that's with you 18 years later. I mean, I'm trying to think of another Silicon Valley company that's actually played out. How do you do it? I mean, I guess you guys must really love each other.
Well, we have a pretty unusual story that is sort of like hard to replicate. We all grew up together. We actually have two other founders. We all grew up together in Seattle. So we went to middle school and high school together, and we had tried lots of startup ideas. And then we went off to college, and we sort of all rejoined forces in succession, to build Box. And while two of the founders have since left, they were here for about 12 years or so. My sort of first co-founder, Dylan, who's our CFO, has been with us been with me the whole time. And I think there's just an important dynamic of having we have a long lasting friendship where we've done lots of projects together, built a variety of ideas up. This was the one that happened to work. I think it's really, if you can get it, it's amazing to be able to work with a founder that long. We know each other's weaknesses. We know each other's sort of blind spots. We debate all day long on every single, decision. But there's certainly a deep rooted, trust and friendship that allows us, to go have really hard conversations, and then, very quickly, minutes later, move forward, and we're now on to the next problem in the business. And that's, again, very unique, and I think is very responsible for, why we've been able to get so far, is having these kind of complementary skill sets, but with, pretty different views in a variety of topics.
Maybe my next one, I'll start it with my my best friend and see if I can replicate this model.
Yeah. No, I mean, it's either the worst advice or the best advice. People say don't start companies with your friends or family.
I disagree with that.
And there's like lots of ways that can, spectacularly, blow up, and you end up in lawsuits and you're never friends again. In our case, obviously we've benefited from not having that, and it's built a level of trust that it lets us go and execute, I think, super well.
So I know Andy is like itching to ask you AI questions, and Nevin wants to ask you a million other founder related questions. We had some debate about it, and I just wanted you to tell jokes.
Okay.
So we can't agree what to spend our time on, but because you're so funny. I love your Twitter. Been longtime follower. But I'm curious. You've been at this so long, and one of the things you're known for, I don't know if this is true or not, so you can correct the rumors if it's wrong, is when Box went public, you were pretty diluted at that point, um, and didn't have as much ownership as some other companies when they went public. And I'm curious, like, we have talked a lot on this pod about, should founders ask for more equity and how much does it matter? And should you fundraise and get diluted? So I'm curious, like, your take on how much that matters. You're clearly still at it. Would that have been different if you had more ownership at the IPO? How do you think about that? And what advice do you have for, new founders?
Yeah, tough one. And unfortunately,
Was.
I don't have like any like good dilution related jokes. It's very, very serious
You
topic.
work on it for Twitter or X, whatever,
Yeah.
whatever we call it.
Yeah, I know I'm holding on to Twitter for a while, but dilution one is really tricky. So would I love more ownership? 100%. I mean, I wish I'd love to have as much of the company as humanly possible. Um, uh, my ultimate calculus, and some of this is kind of hindsight and and revisionist history, but I think, as we went along, we always sort of made the decision of what's going to make the company much bigger. And, we'd rather have a small piece of something really big than a big
Right.
piece of something,
Right.
small or that doesn't work out and be successful. And so we sort of always had that kind of mentality in terms of our ownership stake. And there were multiple junctures. It's actually really interesting. There's sort of almost like two wildly different phases of our fundraising periods. Unfortunately, they both resulted in a decent amount of dilution. But the first period was we raised small amounts of money on extremely low valuations. So that was very dilutive.
Mm-hmm.
And then that was when we were working on getting traction and trying to figure out the idea. And we actually we would do crazy situations, and thank God for some of our early investors and their flexibility. But we had like bridge rounds where it was just extensions of our Series A and our Series B because it was during the '08 kind of economic collapse. And so all of these things were just crazy dilutive because, valuations at the time, at least for us, were our Series A was a $5 million post.
Right.
Yeah, that itself is a joke. I mean, that is that is
That's the
that.
funniest thing you've said the
Yes,
whole
exactly.
talk.
But that's actually not the funniest thing. That was our Series A. Our seed round, our very first seed round, was a $240,000 post. So, or maybe I think
That's better.
yes,
That's better.
I actually know that was pretty. Sorry, it was 320 post. We raised
Wow.
$80,000 on 320 post.
Wow.
We sold a
Wow.
quarter of the company for $80,000. So like that is a good joke. So
That's
uh,
great.
yeah. So like we had basically two eras. One era was extremely dilutive, low valuation, low capital rounds, build out traction, figure out where we wanted to go as a business. And then we actually got traction. We sort of entered more of this hyperscale mode. But this was also then around this period where, Ben Horowitz, I think, famously wrote this post of sort of the fat startup as opposed to the lean startup,
Yeah.
and this idea of
Yeah.
like get big fast, like whoever has the most sales reps and scales the fastest will win their market. We were big believers in that. We didn't, necessarily need the post to kind of prove the point, but our theory was very clear, which is like if you're in this window of hyper growth, you want as many customers as you can get because that's just a recurring revenue stream that can last forever once you can get those customers in at least the enterprise market. So then we flipped where we raised large amounts of money on fortunately higher valuation, but still, each funding round was 10 or 15% dilution at that stage because
Right.
maybe it was, 100 million on a billion or something. And so in both periods, these were pretty dilutive periods. We went into both periods pretty eyes wide open. I don't think we kind of like realized like, okay, if you add all of these founding rounds up, how much dilution is that going to be? But we certainly at each decision point realized that by embarking on that next round, it would open up and unlock a much bigger opportunity for us, or it would mean our survival, depending on again which stage we were at. So it's one of these things which is like I'd love more ownership. At the same time, each of those funding rounds were done, I think, for an important reason to help
Right.
us either survive or scale. And that's sort of the trade, which is, I could complain about it, but each of those rounds allowed us to achieve or build a bigger business. And so I don't really like, it's kind of, you can kind of get mad of like, okay, well, I was only 22. Should I have been able to raise at a higher valuation? Sure. But there's like a lot of things that happen like that. So I think my advice, if in, there's probably not too many things that I would have been able to do that differently because of the economic environment at the time with valuations. The good news is it's pretty unlikely that any founder would have my story today. I mean, your angel round would not be done at $320,000 post. Really, like you should call this podcast if you're doing a round like so that should not happen. But I think fortunately valuations have come up. So your dilution events should be both less frequent and less impactful. And I think ultimately I would always optimize for the scale of the business
Right.
versus the scale of your ownership.
Right.
But I think there's around the margins ways to at least be thoughtful. Like if you can invest more in, not invest dollars, but invest your energy and focus into getting cash flow earlier, you'll be less dependent on external funding. So the more control you can have of your startup destiny, the better off you'll be. The less you'll need to raise, or the less frequently you raise, or the more leverage you'll have when you raise. These are kind of like obvious things, but they end up mattering a ton, which is like, if you are in a position where you literally don't have to raise money, you will always then be in control of how much ownership you have. And in our case, again, we were rarely in control because we were trying to grow so fast, which meant our burn rate was so high, which meant we had to raise more capital, which meant we had to get more dilution. Again, still happy about all those decisions, but you as any founder could at least put yourself in a position where you have a little bit more control of which path you go down. So again, profitability, free, cash flow, being more kind of cognizant of how many venture rounds you want to do. These are all at least factors on the margin you can control for.
And also just to like, what type of company are you actually building? Like, are you building like a SaaS company? Are you building a hardware company? Like, are you building a marketplace? Like, I think all of these different things that, like, they all require different types of funding. And I think just for the listeners, I don't know if you have anything to say on that, Aaron. But like, I think that it's all different, obviously.
Yeah, I think 100%. I think the one thing I would sort of caution and be thoughtful of, and I don't really see early stage founders think about this enough, as much as I'd like them to think about it. Probably
Yeah.
is thinking about the margin of your business model.
Yes.
I think we kind of, I mean, founders are great because we're kind of all like naively like, like all markets are the same, all opportunities are the same, all business models are the same. Like if you can solve a problem for a customer, go after it full force. But like not all business models are the same. Not all opportunities are the same. Not all margin structures are the same. And, there are unfortunately, businesses out there still getting started to this day where you kind of look at it and you're like, even in the best of all scenarios,
Yeah.
you're not going to be able to get a 60, 70, 80% gross margin business out of this. It's always going to be a 10 or 20 or 30% gross margin business. And then if you work backwards from any business that's a 10, 20, 30, 40% gross margin business, you have to run that type of operation so differently than
Right.
a kind of a classic software company. Like there's no room for any degree of any margin of error, any discretionary investment. I mean, these, if you look at how Walmart is run, just the ruthlessness you need to be able to have,
Yeah.
that is not a SaaS company. And so you can't build, a business with the margin structure of a Walmart, with the tools and the methodologies of a Salesforce.com, type margin business.
Right.
These are just entirely different models. And so I do think that sometimes, we get into this trap of building these businesses where, like, even again, at the end of the rainbow, the margin structure won't support, the opportunity or the way that you're thinking about, the funding and kind of going after it. So, or what you're building up operationally or the team or subsidizing, various parts of the business model, or how expensive it is to acquire customers. Like all of those things
Right.
ultimately need to correlate to the margin structure of the company.
Maybe
Yeah.
I'll tee this up, and this will be Andy's segment on AI, but I'll actually just tee this up on like, what do you ultimately think like the gross margin structure for a lot of these AI companies are, potentially, or today, or potentially gonna be, and then Andy can ask all of his AI questions that have been burning to ask you.
This is right
Yeah.
where I wanted to go.
Oh, cool.
I am.
Yeah. I mean, the one challenge is like, AI companies are very all encompassing as
Very,
a concept now at this
very,
point.
very.
So I mean, just at a minimum, if you just say sort of the AI model developers and kind of training, companies, and then versus maybe the application, end user applications, I'm not particularly, bullish on the AI models themselves, because
Hmm.
a friend sort of had this line that I didn't totally understand like 16 months ago. Now I think I understand it like a little at a deeper level. He basically said there's no secrets in AI, and there's sort of two big reasons. One is so much gets done in research papers, and then there's so much talent sort of mobility in AI. And so kind of what that means, if you think about it, is within any kind of 12 or 24-month period, like state of the art kind of converges across multiple of the players. And so anytime you have that in a product where
Mm-hmm.
it's like relatively fungible, and obviously like, underscore the word relatively in this case, you end up sort of competing out profits, because if I can build a model that can spit out text at the same quality as another player, and we both have full access to the talent that can do it, and the training runs that can do it, and the research that can do it, then I'm going to try and lower my price. You're going to lower your price. I'm going to lower my price, and then we're going to end up in a margin structure that doesn't produce a lot of
Mm-hmm.
a lot of excess profitability, because there's going to be different competing interests. So Facebook can give away the whole thing. Google maybe wants to price it at almost zero because it keeps you locked into their ecosystem. Like there's so many different reasons why by basically the profit goes to, very, very small numbers in that part of the ecosystem. So I think the VC dollars that are chasing those companies, it's tough to figure out how you get like big returns, because I don't know how you get 70% gross margin on something that is, again, kind of becomes standard in the industry. The application developers, I would just say they should look like SaaS, type businesses. Where I don't know is sort of who wins and loses, and who gets, who's able to fully take advantage of that. Because, frankly, it's right now, it's a situation where a lot of the incumbents are really well positioned to taking advantage of AI.
Mm-hmm.
And so I'm not seeing yet too many scenarios where AI is sort of disrupting a software incumbent. I'm seeing where AI could disrupt a non-software incumbent, where maybe you have a services business or some other kind of, type operation where AI can replace more of the human aspects of that, that particular business model. But I think in a lot of cases, the incumbents in this market are well suited to leverage AI, in their product. So if you're a CRM or an HR, or an ERP system, already with customers, already
Mm-hmm.
with the workflows, AI kind of slots in pretty nicely. Versus being able to, back in the day, we could all build companies where we could just do like the cloud version of the on-prem company.
Right.
And it was such a big shift for the on-prem company to move to the cloud that you had this window of opportunity where it was disruptive. Well, now all the cloud companies, they're already in the cloud. Their applications are already well suited for AI. The data is already in the cloud. The workflows are in the cloud, and AI just again kind of helps increase the value proposition of those incumbent technologies. So I think there's going to be thousands of great startups, but they probably won't be disrupting Salesforce, or ServiceNow or Workday. They'll probably be doing things that those products didn't previously kind of go after.
So
So we have
SaaS brought into this.
just 4 minutes just for Aaron, or now 3 minutes. So
And I
Andy,
can go,
go.
I can go 5 minutes after.
Okay. Okay.
Yeah.
Great.
All right, cool. So SaaS brought into this business model, you pay per seat. So now we're starting to look like software is usage based. Where do we go? How do you price if you're starting a software company today? I mean, everyone expects you to pay on a per seat basis.
Yeah. I don't. I've above my pay grade. I think we have to see where the market lands on this one. I agree. I mean, there's so many different pricing models that are being thrown around. There's obviously like per unit, token, transaction. There's seed. There's sort of like, can I charge you a percentage of the OpEx that I saved you? So there's like, I probably, if anything, we're gonna end up in a situation where it's just kind of all the business models work, because it'll be
Hmm.
dependent on what particular part of the space you're going after. Like if I go to you and I'm like helping augment or replace like your call center, maybe I could actually just say, okay, you used to spend $20 million, and I'm gonna run this at a tenth of the price, so you're gonna pay me $2 million. Almost like, you know, uh, in a way that's unrelated to what how many seats or tokens or whatever that relates to. It's just like I'm gonna just be 90% cheaper, and that model will work for some companies, but I think it's way too early to know kind of where the business model lands in the space. I think.
Yeah, no, labor augmentation is basically what everyone at the end of the day is selling.
Y Yeah, I think that is gonna be the biggest play in AI. So,
Turn it back to you, Kevin.
Yeah, what do you think? I love your commentary on all things blockchain and uh, everything token based and NFT based. Do you think that uh goes anywhere now? Like obviously like every like technology cycle goes through their hype cycle and we've all seen the graph and like do you think that there is anything that people can actually build like that is okay?
Yeah,
no.
Yeah,
Aaron should get credit because he was like he called out all the Web3 insanity, and
I have
a
been
lot of
talking
people
shit
wouldn't
with
call it
you.
out as insanity. And he was like, one of the few leaders that was like, I think this is a little overblown.
So
Well,
so
mostly I was just trying to make it so we didn't get so crazy that customers would come to us and say, "Hey, where's your blockchain thing?" So, I probably would have, honestly, I would not have ever even cared up until Web3 sort of terminology. Like when it was just crypto or even Bitcoin. Like I don't really, I mean, if like I have plenty of friends that are obviously incredibly bullish on Bitcoin. And to me, it's just okay. If you want to believe in a digital gold, I don't mind. Like it's fine. People have their passions. And I had a friend who was a gold, like he was like a gold miner and like 15 years ago, and didn't interest me that he collected gold, but like that was
right.
like a really interesting thing. So I mean, Bitcoin, if people want to all establish, Bitcoin as the digital gold, that makes sense. The issue that I had was people started talking about, Web3 as if it was, some kind of
The new
successor
mobile.
to
Yeah.
Web2, or like the new mobile, or,
Yeah.
a real platform shift. And it just, didn't stand to reason that that was the case, in terms of how the technology actually worked in practice. So I don't think it'll come back, only because it had nothing to do with the hype cycle or the bubble. Like it just technically can't deliver
I agree.
what people want. I mean, even if literally this thing was 0 cents and there was no NFTs and anything, you still would not put your data on a blockchain, for any kind of real at scale application, that any of our parents would use, or something. So it's just,
Gaming
yeah.
NFTs? Come
No, so
on.
I got
Or
I got totally convinced for like a couple weeks that, okay, maybe that could work, or these things, and then no, but then you just kind of always go back to like, okay, just APIs do all these things, and then you don't
I
need to,
totally
and it
agree.
and then you don't need to
Yes.
worry about people having crypto wallets, and like it doesn't increase the portability because some other game developer still has
Uh,
to support whatever that standard is. And so once you've done all that work, you could have just had a normal, web app or web service with an API. So I don't think it's going to come back, in the fashion that we had seen it 2 years ago. Does crypto survive? Sure, because it's clear that Bitcoin's not going anywhere. But I do think it's going to be a pretty different environment than what some had anticipated.
Do you think that there is like an actual like cheaper alternative like internet currency like versus everybody paying by credit card? Like obviously there's ACH. I'm a B2B business, so we accept credit card, but we charge extra for it. We also accept ACH, and it's like a 30-cent fee or something like that. Do you think that there's going to be, and I know like David Marcus is working on something like he spun up from Facebook, and Solana has something like this. Do you think that there should be, or could there be a cheaper, basically MasterCard or Visa that doesn't take the 2.9% that we all pay?
Um, I guess if you whiteboarded it out, you could get there, but like, the every time you start to add back in all of the reasons why we have all those centralized platforms,
Yeah,
you add back in, more or less a similar amount of all those costs. Like I don't want to be able to send, a transaction to the wrong address and then never get my money back. If I make that mistake, whereas I can call a bank and have them undo that transaction, or there's some fraud prevention team. So it's just like once you add back all of that, that's sort of why we have the 1% fee and all these things. And so
yeah,
in 50 years from now, is it possible? 100%. I would just my bet would be more on Apple doing this all within platform, or Google doing it all within platform, and we can trade money with zero fees, because it's just a database row change on their end. Like I would anticipate that's a more logical solution than us having a trustless transaction that we can never unwind. And the moment I lose one set of keys, I lose all my money. Like
right.
like that. There's like doesn't
Yeah,
seem like the future.
I agree.
So
Do you want to end? I think Aaron has to leave here. Do you want to end on for our listeners? So like our listeners are first time founders on any maybe it's a comic relief or some other wise wisdom that you have as we kind of say goodbye to you here.
Well, I don't want to end on crypto. So so whatever. I'm happy to take any other final topics, Andy.
Would you do it again? So, I mean, I think you saw NVIDIA's CEO was asked this
Great question.
famous
Great
question. So
question.
you're 18 years in.
Yeah.
So would you do it again? And what would you do?
I would do it again. And Jensen's answer was what is like very deep. Like you got to like unpeel the onion like 5 layers to like deeply understand like his whole point. Because I think his actual underlying thing was he literally personally would do it again, but it was a conveying of like how freaking hard the whole thing was, and there's no alternative for him.
Yeah.
In terms of what he gets passionate about, and that's generally my view, which is that it's super hard. Obviously, you cut your teeth on just all day long, and you're working 24/7. I can't see an alternative that I would be excited to do. I tried. I was an intern a couple times, and I'm like the worst employee, probably like from just like an IC standpoint. And so like I could never have survived in a real organization. Like one performance review cycle, they would have pipped me out. So this was the
I feel
only.
like you would be able to get a job that was a little bit better than I see.
No, seriously, I was so bad. I was so
No,
bad.
no, I mean now.
Oh, now? Okay. So
You could probably find something else.
I think I literally would make it to like the half-year review cycle, and then they would be like, it's not working out. I don't see how. So this is the only thing I could do. And I'm super.
Look,
I'm,
if
I'm-
you ever want to take over as CEO of Winnie, that job
Yeah.
is open and available.
oh, I'm down for other CEO gigs. So
Yeah.
I'm happy.
She's
to
offered this to everyone. You
Yeah.
are special.
Yeah, no, she's offered
Cheers.
her.
I mean, I could use a different industry
You
for.
can just add it on, just a little slide thing right there. Go
Yeah.
for it.
No, I'm too into files. That's the weird part. I love files. So if you guys get into document management, let me know. But yeah, no. So this is what I love doing. I wouldn't do anything differently, and I would, certainly if tomorrow I wasn't, at Box, I'd have to just try again, doing it again. So it's I think, as we all know, it's hard to get this much fulfillment from anything else, and it's a crazy life that we've chosen, but it is
Yes, it
there's
is.
nothing like it. So yeah, I mean, my
Agreed.
probably my final call out would just be, I think the key is to do something that you're super passionate about. And it's interesting, the crypto thing, maybe just to tie back to that, or even AI, frankly. I do think that you have these waves where there's a really exciting kind of moment in time in a technology market, and a lot of people go after and sort of chase opportunities in those markets. And the problem is, the hype will always come down. The bubble will always burst. It'll always be uncool to do the category that previously was cool. So you kind of really have to care about what you're doing. You have to find a way to have sustained, kind of passion about whatever that particular
Yeah.
product is, or else it's hard to then outlast the 3 to 5 year, kind of window where maybe there is some hype in your
Right.
category,
Right.
to the 10-year, window, which is, ultimately how you build something sustaining. I got super lucky. Like, it's not like I inherently cared about files, but we got really passionate about what we actually can do for enterprises.
Right.
And that's allowed us to kind of outlive, hype cycles over the years in and around, parts of categories that we play in. And so, ultimately, I think for any founder, you have to do something that you're truly passionate about, and hopefully people can find that organically, because it's super awesome if you land on it.
Well, thanks so much, Aaron.
Yeah,
This has
thanks.
been
Thank you.
great. As
This was
long as
awesome.
you press leave and let it upload 100%, we all are all good.
Okay,
We're going to continue on. But thank you so much for your time.
great. All
Thank
right,
you.
all right. Thanks, folks. See ya.
Bye. All right. Aaron has left the building. That was, I think that was
That was great.
That was
a
awesome.
very educational, even
18 years on the same thing.
yeah.
I mean, that's
I
insane.
looked at his crunch base and it
You just
said
can't do math, Kevin, because if he started in 2006 and it's 2024, I mean, that's 18.
Oh, I
And
must
we
listen to
have an
something different.
MIT math major here talking
I
to
know,
us.
I minored
No,
in
no, she's she's a CS
majors in
major.
computer science.
Come
I
on.
Only the
started out
minor.
as a math major and it was
Learn your
like
host. Learn
too
your
boring.
host. Come on. So what do we want to talk about for the rest of the 20 minutes that we got here? I think that was an amazing episode. I think that one thing that I brought up initially, that I think that it doesn't really exist anymore in Silicon Valley. It used to. I when I was in the hype cycle. I was able to get time with Travis from Uber and Brian from Airbnb, and also Aaron. That's how we got him on the show, and Drew from Dropbox, and it's too bad that I don't think that exists anymore outside of what you pointed out, Andy, through intro. So it's kind of sad that
Well,
maybe we
I
move
think
to
it
this
does
digital
exist.
world. Does it? You think so? I think that it's more subgroups. I think that like our group that we have, like our WhatsApp group, is like one of the most important groups, and what I learn more about everything from. But it just doesn't exist at that. I was talking to Brian Chesky when he was at the height, and he was talking to me, and he was getting like weekly meetings with me. Like, that doesn't happen, man. It just doesn't
I think
anymore.
it does. I've never felt like there's nobody I can't meet with. I've been very impressed, and I'm not going to name names here, of the people who meet with me on a weekly or a monthly basis.
Come on, I didn't name names.
It's
Name
not
your names.
appropriate. I don't know that they want me to say who I meet with. but I meet with some very impressive people who are billionaires in tech, and they always make time for me, I
I
feel
think
like.
there's just like a little bit of a different bar now because there's such a proliferation of founders. Like
That's true.
I
That's
will
true.
meet with people, but I do have to limit it because it could just be kind of like insanity. I could spend all my day just like mentoring people, but I have a company to run. So I usually kind of require that they've hit a certain level of success. Um, or there's like other people that can mentor them, that are closer to the stage they're at and not like 8 years into building a business. And they can listen to the pod if they really want to hear from me. So I think
Or
Right.
it's just
book you on intro.
right. You can't like as a brand new founder, you can't aim for Brian Chesky, but like you can aim for someone who's raised their seed round or their
Yeah.
Series A, and like vice versa. I feel like I could probably call up a lot of people who have, you know, successfully sold a business or, raised like Series C and beyond. But can I like go knock on the door of like massive, Mark Zuckerberg? Like, no, I need like more of a connection there. And it's just it's just the fact of the matter. There's so many more founders now, and it's
That's actually
you
a
know
great point.
so much
Yeah.
easier to start a company, which is a
Yeah.
great thing. But like, you just have to, every CEO running a business has to be a little more selective about who they meet with, and like you have to be more thoughtful about like who you ask for their time of.
Yeah.
Hi.
I think that I'm being maybe a little nostalgic as far as like when I started my first company, but you're completely right. And also just like look at the past 50 episodes that we've had on this podcast, and like what we're trying to do is trying to share that knowledge. And we've had other billionaires on here, and other really famous founders that have shared their war stories and
Yeah.
all that stuff. And so I think that yeah, you're right. I
There's a
am
lot more of
being
that content out there now too.
yeah,
So like
yeah,
meeting with
yeah.
someone to be like, what was the hardest part of founding a company? Like just look on the
That's
internet.
gone. That's gone. Yeah.
And you really should be meeting with people in your industry that have specific knowledge and
The but
expertise.
but the only thing you don't get, I will say this, like you don't get the real stuff. So
Yeah.
obviously, like Aaron was like as transparent as he can be, but he's a public company CEO. Like
Right. Yeah. Yeah.
he's not going to give you the real details. Like when I asked him, like, when like what were the hardest points on your company, he's not going to say like,
It's
oh,
today and our
uh,
stock is about to.
yeah. Like, no, well, to be clear, Box is doing amazing.
Yeah.
So
Yeah.
let's not
But
say
he
that.
can't tell us if they're about
He
to not be doing amazing because
and also
he can't.
and also like through us, and one of the questions that was kind of posed in the group channel was like, what is the worst VC to invest with? And like he can't answer that. There's no way. And so that's what you get on like a personal to personal level. And that could be also like Sarah plug YPO, or a
Yeah.
plug the Hamptons that is started by
Yeah, there's like YPO
uh
is like if you're looking for a CEO membership group and you are like at a certain stage in your business where you've reached a certain level of success, like there's nothing that compares to YPO. Like none of these they're all trying to be what YPO has been
sure.
for many years.
I'm just trying to throw a bone. Like Sam
Are you an
is
investor in Hampton? Is that what you're doing? You're pushing
no
your book here?
Sam's actually an investor in us. So
Ah, got
Right.
it.
Well, okay.
I'll put that out
I
there.
like that there's
I'll put
other
that out
networks
there.
because not every business can get to YPO. So there's like Chief for women, and you don't have to be a CEO to be in that. But like if you are a CEO and like you have reached the milestones to be a member of YPO, like highly recommend you
So
just join the
wh-
real thing.
what are those milestones? Let everybody know.
So
Like,
it's on their website. I'm
oh,
gonna
okay.
butcher it. It depends on like if you so first of all, you have to be it's young presidents organization, so you have to be under 50. You have to have either 50 full-time employees or 15 employees and at least $2.5 million in annual employee compensation. You have to have a certain amount of revenue or a certain amount of enterprise value. So if you're, like a venture-backed company that maybe doesn't have a ton of revenue yet, but you've been valued really high, that could count. Um,
So how
so anyway, that's
how do you use YPO for anybody else listening here?
I mean, for me, it is that like network where people get really real and share like the stuff that they wouldn't share on a podcast. And because it, has such strict membership requirements, like it's everyone that's reached a certain level of success and is actively operating a company right now. So it's very like real time. Like this isn't dated advice of, what it was like 15 years ago. Um, and I do feel like people share stuff that, what people to avoid, what investors to avoid, what, that kind of stuff that you would not ever share outside this like super confidential group.
Right. Got it. Okay, so for the remaining 10 minutes that we have, what are some okay, let's go to Andy here. I know you have a lot of AI related news
Yeah.
that's probably happened since our last podcast with Siki. What do you got? Like what's the latest?
Oh man, you just put me on the spot. What's new in AI? I don't know. I think everyone's eagerly awaiting for GPT-5. I think
Hmm.
what I'm waiting for is I bought a Vision Pro. So I'm
Yeah.
waiting to
$3,500.
I bought a $3,500 Vision Pro, and I am
Did
proud to
I
say it.
get one? Like, or is it too late now? I like
I
missed.
think you can get one a week later, basically, or you can go to
Oh.
the Apple store and I guess the Burlingame Mall. Is that where there is one?
On Burlingame Ave. There's no
Burlingame
mall.
Avenue near Starbucks. Yes, I forgot.
So
So wait,
and
what is the Vision Pro? What are you most excited about that it does?
That's the funny part is I'm not even sure. What I'm excited
So-
about is the fact that I have a piece of hardware made by Apple with a bunch of cool stuff, and I hope it's going to be amazing. And if not, I'm
Can I
going to
wear
return it.
glasses and get it or no?
Yes. So if you wear glasses, they take your prescription and they customize the lenses for you.
Oh, so I got to
So-
figure out what my prescription is before I place
Yeah,
an order.
You have to upload your prescription, Sarah.
One question, Andy, like after you use it 2 or 3 times, like is there like a recycling place you take it to? Like how does that work?
Well, if I don't want to use it after like 3 days, I'm going to return it because Apple has like a 14 or 30-day return policy. So let's start there. Second,
Okay.
there's this place
Okay,
called
that's
eBay.
what I'm asking. Yes. Okay.
Second,
Why
there's
don't you
this
tell
place
us, when are you getting yours? And can you tell us then if it's good and we could just get one then?
February 2nd.
Okay,
Morning.
great. So,
I will tell you. My
yeah.
expectation is very high. I mean, the keynote, the videos they've been putting out, you have a 100-inch screen in front of you at all times. You can see through it. So it's not VR, it's augmented reality. For a plane, it looks like the greatest thing ever. So
Yeah, for a plane it does.
And
I
Movies
get
it,
how we run our-
movies it
interested.
does.
I can't
Yeah.
look at any screen on a plane.
Oh, interesting. Then
I
this is probably not for you on a plane.
Oh, damn. If that's the use case, I'm screwed. I can't do anything on a plane, a car, or a boat, something.
I'm curious what it's going to be like to work all day on it. So, I mean,
You
we
work
spend.
that
Work
on?
all day on it? Are you
Ah,
insane?
I'm
What are
going to
you
use
doing?
it for 3 or 4
You would do
hours.
sales calls with that.
You're going to have an avatar. It's going to be a great talking point. And I mean, you're going to have a Zoom. Or
No,
when it.
you're not gonna have an avatar. Are you kidding me?
Have you seen it? That's what they literally. It scans a lifelike avatar of you. And
Okay, I think
creates
we
it.
just wait till you get yours and then we try it out on this
Agreed.
pod and we see what
Knowing it's Riverside, it's probably not going to work with
Yeah,
this, just to be
totally.
totally
Okay.
clear.
I think that we're done with topics because we had everything like around Aaron coming on. We were very excited to have him on. Why don't we end the pod early unless you guys have any other things to add?
Gotta go back to grinding, man.
We're going
Time
back
to
to
grind.
grinding. So
I'm good.
thank you everybody for listening. Like, subscribe, whatever platform you are on. Thank you for listening. And go try Box. He
if you're an
didn't.
enterprise.
Yeah, if you're an enterprise, go try Box, and we will see you next time.
Bye.
Bye.